AI has been the hottest investing craze on Wall Street and in venture capital circles. But are any of these AI companies ever going to actually be profitable? Because right now, investors are pumping billions into AI companies, and these same companies are returning just pennies on the dollar, if they even have any revenue at all. Even OpenAI, the creator of ChatGPT and the poster child of the current AI craze, has been unable to actually turn a profit, with some reports claiming the company might lose $5 billion this year alone. And somehow, in spite of all of those steep losses, OpenAI was still valued at over $80 billion in its most recent deal this year. All of this has led Goldman Sachs to recently publish a report questioning if the AI investment hype has gone way too far. They noted that tech giants and other Silicon Valley companies are poised to spend over $1 trillion in the next few years on AI investments. But whether this infrastructure investment will pay off for companies is actually very uncertain. It's incredibly clear that the ultimate success or failure of AI companies hinges on whether they are able to significantly boost economic productivity for their customers. And this productivity boost has to come at a reasonable cost. If AI can't be productive at a cheaper cost than what it would take to hire an employee to do the same job, companies aren't going to be interested or care. And that's a problem for AI startups, because artificial intelligence is often incredibly expensive compared to what a human can do. Goldman Sachs noted in its report that while AI was able to update historical data and their company models faster than what humans were able to do, it also did so at 6 times the cost. Because of the large price tag involved with AI computing, one MIT professor Goldman Sachs interviewed for its report estimated that the amount of tasks that AI can actually profitably impact over the next 10 years is just 5% total. If AI companies can't start to actually deliver results for potential customers at a cheaper cost, these AI startups aren't going to be able to grow their sales significantly and achieve profitability. And at the moment, the current sales of AI startups are honestly pretty bad. The prominent venture capital firm Sequoia Capital estimated that the industry sank around $50 billion into NVIDIA chips, while generative AI startups brought in just $3 billion in revenue over that same time period. This market dynamic means that all of the real profits surrounding AI are actually being generated by semiconductor companies like NVIDIA and other hardware and infrastructure providers. Big tech companies and AI startups are set to throw at least $150 billion into NVIDIA's AI hardware this year alone. But software companies and the startups that are actually trying to build AI applications are not making money on these hardware investments yet. You can see this dynamic very clearly in the recent stock performance of software companies compared to the massive outperformance of AI hardware companies. But this is not a sustainable market dynamic for anyone involved. If artificial intelligence startups and software companies can't actually start to make money from AI applications, they will eventually be forced to stop investing money into NVIDIA GPUs and other AI infrastructure. Right now, everyone is buying up GPUs to build AI models with the assumption that they'll be able to make money with them in the future. But that's far from guaranteed. Because another major issue facing these companies is that increasing competition and a lack of differentiation between AI models means that artificial intelligence could easily become a commodity that lacks real pricing power. The differences between many large language models and chatbots are relatively insignificant, and this is a fact that many AI founders are keenly aware of themselves. The differences between OpenAI's GPT-4 model, Google's Gemini model, and Meta's Llama model are arguably pretty minor and indistinguishable when considering the use cases of the average person. The fact that so many AI companies have similar capabilities and offerings means that they have to compete with each other primarily on price. This lowers profit margins for everyone involved and will make surviving difficult or impossible for many AI startups. And that's not even taking into account the fact that there are many free and open source AI models that already exist in the first place. It's hard to sell a product when there's a free option available to everyone. Many AI startups are also already struggling or failing outright. Inflection AI, a chatbot startup that raised $1.5 billion, found that it was unable to generate any significant revenue after it had actually built its product. This led to the company essentially being backed into a corner and forced to sell its most valuable assets to Microsoft. The remaining company has lost almost all of its employee talent and is a complete shell of itself. Another high-profile AI startup named Anthropic, which has raised more than $7 billion with backing from Amazon and Google, is reportedly spending about $2 billion a year, but it's only making $150 million to $200 million in revenue. And Stability AI, the makers of Stable Diffusion, had their CEO recently depart, along with a wave of layoffs and company restructuring, after investors grew increasingly unhappy with the company's continued losses. All of these factors are making the current AI investment boom eerily similar to the dot-com bubble of the late 90s. AI as a technology is probably here to stay, much like the internet was from the dot-com bubble. But similar to all of the unprofitable dot-com companies of the late 90s, AI startups lack a viable business model at the moment, and the technology is still very early. Because of this, it's very possible that many of these unprofitable startups won't exist even 5 years from now. And like all of the past investors who piled money into startups that ended up in the dot-com bubble graveyard, many current investors trying to pick individual winners in AI could get seriously burned. Even Cisco, the dominant stock that was the backbone infrastructure provider of the internet, has never managed to recover to its previous highs after the dot-com bubble burst and its profit margins declined due to increasing competition. Nvidia currently has gross profit margins above 75%, but with increasing GPU competition from companies like AMD, Nvidia's current growth rate and margins also seem equally unsustainable, and their pricing power will almost certainly decrease as the competition catches up. As Goldman Sachs head of global equity research said, quote, "Overbuilding things the world doesn't have use for or is not ready for typically ends badly." The Nasdaq declined around 70% between the highs of the dot-com boom and the founding of Uber. A big part of what has been driving this current AI investment cycle is also big tech essentially investing in artificial intelligence simply to protect their own market dominance and to prevent any disruptions to their core businesses. Big tech companies like Google, Meta, and Microsoft are continuing to invest heavily in AI infrastructure simply because they are worried about the risks of underinvesting in AI if it does eventually take off. Tech CEOs have explicitly said as much on their earnings calls. But it's very possible that revenue growth in the AI market simply won't materialize at the rate that many people are expecting. And if that ends up being the case, big tech companies aren't going to continue feeling like they need to hedge their bets with even further investment in AI computing capabilities. And when that happens, we will very likely see the AI investment hype fade. Everyone knows that the oldest trick in the Silicon Valley playbook is to take investor money and focus on sales growth and capturing market share by any means necessary. These AI startups don't mind burning cash while they focus on sales growth in the hopes that they can become one of the dominant players in the space. But this strategy only works if there's a pot of gold at the end of the rainbow, and the company can eventually become profitable. These startups have to be able to make real money eventually. Investors won't fund a company's operations forever with no return on investment in sight. And with AI's current economics, turning a profit is very much in doubt. But be sure to like the video and subscribe to the channel for more finance and business content. And let me know what you think in the comments below. Thanks.